Welcome back. It's the global news segment now. We'll tell you what's happening in other parts of the world. We start from Japan this morning, where core consumer inflation in the country's capital has stayed above the central bank's target and has accelerated in March on steady gains in food costs, talking about food again, and then keeping alive market expectations of a near-term interest rate hike. Service sector inflation also perked up as rent prices rose ahead of the April start of Japan's new fiscal year, backing up the Bank of Japan's view that price pressures were broadening. The data will be among key factors that the Bank of Japan will scrutinize at its next policy meeting, which is April 30 and May 1, when the board is set to issue fresh quarterly growth and price forecasts. And nationwide core inflation accelerated above 3% in the first half of the year before slowing as the boost to import costs from the weak yen eases. And consumption, observers say, is weak. So the key is whether households can swallow further price hikes. The Tokyo Consumer Price Index, which excludes volatile fresh food costs, rose 2.4% in March from a year earlier, faster than a median market forecast for 2.2% increase. It accelerated from a 2.2 gain in February. A separate index for Tokyo that strips away both fresh food and fuel costs, closely watched by the Bank of Japan as a measure of domestic demand-driven prices, went up 2.2% in March from a year earlier, from 1.9% in February. The main driver, again, there is food. Then from there, we head to China, where the escalating trade war with the United States has prompted Beijing to further expand its ties with Central Asia as state-backed firms look to substitute U.S. imports and reroute their exports. In what appeared to be an attempt to downplay tariff worries, recently dozens of Chinese corporate representatives traveled to the neighboring country to explore partnership opportunities. China has established itself as a leading trade partner and top foreign investor to the 5 Central Asian nations, which includes Kazakhstan and Kyrgyzstan, among others, a bloc that has been viewed as a key gateway for its Belt and Road Initiative, a major infrastructure program announced by President Xi Jinping during an official visit in 2013. The U.S., however, has been long sidelined in the region as we see that Washington aims to absorb the region into its sphere of influence, as stated in a State Department strategy document titled U.S. Strategy for Central Asia 2019 to 2025. But its efforts seem to have fallen short. Also, President Xi Jinping on Friday met with global executives and has made a case for investing in the country as Beijing focuses on reaching out to businesses amid escalating trade tensions with the U.S. And the president said that multinational companies had a big responsibility to uphold global order and that they needed to work hand in hand with China. Still in China, Chinese companies' latest earnings reports point to an improvement in consumer spending, though it's not necessarily back to pre-pandemic levels. E-commerce giants Alibaba and JD.com both said in their last several weeks that their China retail business saw faster year-on-year revenue growth in the last 3 months of 2024 than in 2023. And they think that consumption growth in a period of healthy recovery, but, well, not yet where they think it should be for consumer spending to return to pre-pandemic growth. Chinese companies' revenue growth likely needs to recover by double digits, and consumer confidence needs to improve, according to one of the market analysts. And Chinese policymakers have emphasized that boosting consumption is a priority this year. So far, authorities have expanded a trade-in subsidy program to include smartphones on top of home appliances and electric cars. In September, Beijing also signaled a shift in real estate policy by calling for a halt in the market decline. From China, we'll go to India, where that country has offered tariff cuts on imports of U.S. farm products like almonds and cranberries as a further concession to the United States. according to government sources. They hope to avert President Donald Trump's reciprocal tariffs, which is set for next week. Unlike China, Canada, and the European Union, India is actively seeking to appease the Trump administration and is open to cutting tariffs on over half of U.S. imports worth $23 billion. In a series of meetings in Delhi with Brendan Lynch, the assistant U.S. trade representative for South and Central Asia, India agreed to cut tariffs on bourbon, whiskey, and agricultural products such as almonds, walnuts, cranberries, and a whole lot more. The talks to fast-track negotiations is likely to be concluded today, Friday. And they say the talks are progressing well, and the bilateral trade pacts still in progress and will benefit both nations, according to Indian Trade Minister. And then we move to Thailand, where the country is aiming to reduce its trade surplus with the United States to $20 billion by importing more U.S. products. This is according to the Ministry of Industry. The United States was Thailand's largest export market last year, accounting for 18.3% of total shipments. That's about 54.96 billion. And head of Industry Ministry's Economics Office gave no time frame for this surplus reduction, but saying that governments would increase imports of agricultural produce such as corn, soybeans, and this may affect domestic products. The Commerce Ministry has said that Thailand had a trade surplus with the United States of $35.4 billion last year, while Washington has put its deficit with Thailand at $45.6 billion. So we see which way that goes for Thailand and the United States. And talking about the United States, tech billionaire Elon Musk, whom U.S. President Donald Trump has tapped to shrink the government, said that he would finish most of the work to cut $1 trillion in federal spending when his tenure ends in as soon as 64 days. Mr. Musk said that he was confident that his Department of Government Efficiency could find $1 trillion in saving, claiming current total federal spending levels of about $7 trillion down to $6 trillion. Musk is the world's richest person, was designated by the White House as a special government employee, which caps his work at 130 days. That means this period leading to the Doge operation could finish as soon as the end of May. And of course, we've been seeing a lot of cuts and drastic decisions by Doge. Doge estimates that it has saved U.S. taxpayers so far $115 billion as of March 24 through actions including workforce reductions, asset sales, and contract cancellation. However, the savings total published on the Doge website is unverifiable, and its calculations have been, they say it's been riddled with errors. Well, still in the United States now, one of the most popular acronyms in Silicon Valley at this time is SPV. Yes, a special purpose vehicle in tech stack land. It's a type of investment fund that typically involves concentrating all of its assets in one company. SPVs have blown up in recent years as investors clamor to get a piece of hot startups with valuations often in the tens of billions of dollars. But buyer beware. Investors are warning of hidden fees, unclear rules, and ownership, as well as marketing that's driven by FOMO, or the fear of missing out. Traditional venture capital funds spread risk across a portfolio of startups with the understanding that most bets will fail and that one or two successes will pay back the fund several times over in an SPV, which is a fund manager. So buyers beware is the notion there from Silicon Valley. Now, the European Union is set to impose minimal fines on Apple and Meta platforms under its Digital Markets Act next week in a bid to avoid worsening tensions with the United States President Donald Trump. Apple will be fined and ordered to revise its App Store rules over antitrust concerns, while Meta will be fined and will be ordered to change its pay or consent model and citing people that this may affect. Well, EU regulators will also close another investigation into Apple over the company's design of its web browser choice screen, with no more sanctions on tap. And then the companies can face up to 10% of their global turnover in penalties, which would have resulted in steep fines for both countries. So talking about the influence of President Trump on those United States companies, even though they're operating in the EU. Now, Alibaba, the e-commerce giant, is seeing growth in its core business and has become one of the leading artificial intelligence players in China and globally, competing with the likes of OpenAI and DeepSeek. Remember what DeepSeek did? Alibaba is now in favor with the Chinese government, and Alibaba's US-listed shares have quietly risen about 60% this year, adding more than $100 billion in 3 months. Imagine if you had an investment right there. I'm sure you'd be smiling at this time. Let's go to the UK now. Britons are saving an historical large portion of their disposable income, a sign that consumers are reluctant to spend in the face of a weak domestic economy and turbulent global backdrop. The savings ratio rose to 12% in the fourth quarter from 10.3% the previous 3 months. This is according to the Office for National Statistics. Well, it was the highest since 2010, excluding the pandemic. Prior to COVID, it stood at less than 6%. And the office confirms that the UK saw modest growth of 0.1% in the final quarter of 2024. Closeouts in the UK now. Households are accumulating a worryingly large amount of energy bill debt. That is actually worrying, as they face some of the highest prices in the world at a time when government welfare reforms are set to push more into poverty. Juliana mentioned this yesterday. Well, consumers owe £3.7 billion for electricity and gas. That was for 2024, according to a report by the Committee of Public Accounts. The latest, they say that's more than double the debt recorded in 2021, when Europe's energy crisis was just starting to brew. Not so good for UK households at this time, and in spite of this, the government has its eyes set on cutting some of those welfare packages. I wonder how that will affect, or, well, we know it will affect them negatively, but, well, we'll talk about this in the coming days with Juliana, correspondent in London. But for now, I have to say thank you so much for being a part of Business Morning this time. I do hope it was worth your time. I'll just leave you for a bit, gather some updates, and then I'll be back at 1 p.m. during Business Incorporated to give you a more robust and updated news from the world of business and economy. I'll be here with Aniti Edit. See you later.